Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
Hey, it is great to be here for this deep dive.
Yeah, today is Saturday, February 21, 2026. And if you are a learner out there, someone who wants to understand the economy without reading a PhD, you might be looking at the news this weekend and feeling a little confused.
Oh, absolutely. It
Except,
feels like two completely different realities right now.
exactly. On one hand, you have this massive political earthquake. The Supreme Court just handed President Trump a major defeat on his favorite trade tool. But the administration is already rolling out a plan B. We're calling this the tariff twist.
Right. And then on the other hand, you have the market mirage. You look at the stock market, and it is just perfectly calm.
Hmm.
But deep down in the bond market, the plumbing of the financial system, there is a massive storm brewing.
A storm fueled by government debt and a ton of spending on AI. So our mission today is to look past the surface headlines. We want to show you how these two stories actually connect and why that calm stock market might be hiding some real risks for your money.
Yeah, we are going to translate the jargon into plain English.
Let's jump right into the deep end. Story number one, the Supreme Court versus the White House. Yesterday, February 20th, a huge ruling came down. What exactly happened?
So the Supreme Court effectively unplugged the president's fastest economic tool. They ruled against the use of something called the IEEPA for broad tariffs.
Okay, let's pause. IEPA. It sounds like a sneeze.
It does. It stands for the International Emergency Economic Powers Act. And for a long time, the administration used this as an easy button for tariffs. The logic they used was basically economic security is national security, therefore we can tax imports right now.
But the court finally stepped in and said no.
Exactly. They ruled that unless there was a literal declared war or a very specific undeniable emergency, you cannot just use this act to rewrite tax policy on a Tuesday. That power belongs to Congress.
And according to the reporting, the reaction to this inside the White House was, well, volatile.
Very. Looking at the data and reports from a private meeting with governors, President Trump called the ruling a disgrace. He actually just walked out of the room. It is a massive blow to executive power.
But, and I think this is the crucial part for our listeners, it does not mean tariffs are suddenly gone.
Not at all.
I want to use an analogy here. Imagine the president is a truck driver. He's trying to deliver a massive payload of tariffs from Washington, D.C. to the rest of the world. And for the last few years, he has been cruising down this private, high-speed superhighway called the IEEPA Expressway.
Right. No speed limits, no toll booths. He just drives.
Exactly. But yesterday, the Supreme Court dropped a concrete wall right across that highway, road closed, indefinitely.
But he didn't cancel the delivery.
No, he just pulled out an old map and started looking for side streets. The administration is pivoting to a network of older, much slower laws to get that exact same cargo to the exact same destination.
The side streets are a perfect way to look at it. And the first side street they just turned on to is called Section 122.
Okay, break that down for us. What is Section 122?
Think of Section 122 as a temporary detour, a pontoon bridge over a river. It is a provision from the Trade Act of 1974 that lets the president impose tariffs specifically to fix balance of payments issues. Basically, if the U.S. is bleeding too much cash to foreign countries, he can apply a temporary patch.
And they moved incredibly fast on this.
Almost instantly. They announced a 10% global tariff using this specific authority. But here's the catch. It has a strict time limit.
It's not a permanent road.
Right. It only lasts for 150 days. It kicks in on February 24th, which is this coming Tuesday, and it expires around July 24th.
So if you are a listener out there who runs a small business, maybe you import electronics or sneakers or auto parts, what does that 150-day clock do to you?
It is a nightmare for planning. It creates what we call a policy cliff. You know your costs are going up by 10% next Tuesday, but you have absolutely no idea what happens in July. Do those tariffs drop back to zero? Do they double? You can't price your goods accurately.
Uncertainty is just poison for a business.
It is.
So Section 122 buys the administration about 5 months. What happens when that temporary bridge runs out in July?
That is when they have to merge onto the heavy machinery. The next road is Section 301. The U.S. Trade Representative Jamieson Greer is already launching accelerated investigations under this section.
But Section 301 is structurally different, right? You can't just blanket tax everyone with it.
No. If IEPA was a shotgun, Section 301 is a sniper rifle. It requires the government to prove that a specific country is doing something distinctly unfair, like They have to prove there are unfair digital taxes or forced labor or ocean pollution or discriminatory drug pricing.
That sounds like it involves a lot of paperwork.
So much paperwork.
Yeah.
It is incredibly slow. You have to investigate, you have to hold public hearings, gather evidence, draft massive reports. The administration says they can speed run this to have it ready by that July deadline, but the game has fundamentally changed.
Right, because under the old highway, the president could practically announce a tariff at 2 in the morning and it would be law by breakfast.
Exactly. Under Section 301, he needs a small army of trade lawyers and thousands of pages of justifications.
So the intent to keep the tariffs is 100% still there. But the velocity of government action has dropped from 80 miles an hour down to like 20 miles an hour in a school zone.
That is exactly it. And that slowdown creates friction costs. It makes everything stickier and more bureaucratic. And we haven't even talked about the nuclear option yet.
You mean Section 338?
Yes, Section 338. It is this ancient, obscure law that actually allows the U.S. to slap 50% tariffs on countries that discriminate against American commerce.
50%, wow.
It is incredibly aggressive. It is rarely ever used because if you drop a 50% tariff on someone, you are almost guaranteeing a massive trade war retaliation. But looking at the data, it is officially on the table now as part of Plan B.
There is one more number from the recent analysis that really stood out to me on this trade story, and it is a very, very expensive number. $175 billion.
Yes, the refund hangover.
Explain this because this sounds crazy.
Okay, so the Supreme Court just ruled that the old way of doing tariffs was illegal. Because of that, there is now a massive legal argument forming that the government actually has to give all that collected tariff money back to the companies that paid it.
Wait, like getting a refund at a store because they overcharged you, but for billions of dollars.
Precisely. The Penn-Wharton budget model estimates the total exposure could be up to $175 billion in refunds.
That is not just finding a $20 bill in your winter coat. That is a full-blown budget crisis.
Now, the Treasury Department is out there saying, we can handle it, and this litigation will drag on for years in the lower courts. But think about the irony. If the U.S. government is suddenly forced to hand $175 billion back to importers, where do they get that cash?
They don't have a giant savings account. They run a deficit. They have to borrow it.
Exactly, which means issuing more debt, selling more bonds. And that connects perfectly to our second story today.
Right. Let's pivot to the markets, because if you just log into your brokerage app right now and look at the S&P 500 or you look at the VIX, the market sphere gauge, everything looks serene. We had a little bump in January and February, but it settled down.
It is a total mirage.
You used an analogy in your notes about a duck on a lake, which I loved.
It is the best way to visualize it. If you watch a duck gliding across a lake, above the water, it looks perfectly smooth, calm, totally unbothered. That is the stock market right now. Volatility is super low. People feel safe and wealthy.
But below the water.
Below the water, those little web feet are paddling furiously, just fighting for their lives against these massive underwater currents. That paddling, that is the bond market, specifically the market for long-term U.S. debt.
I really want to break this down because I know as soon as people hear the words bond market, a lot of listeners just tune out. Why does a normal person, a learner, need to care about bonds?
Because the bond market literally sets the price of money for your entire life.
Okay, how so?
Mortgage rates, car loans, business loans, credit card rates, they all track the yield on government bonds. If the bond market gets chaotic and yields go up, your everyday life gets way more expensive, even if the stock market is hitting record highs.
All right, so let's look at the currents this duck is fighting. Current number one is the government itself, right? We have a supply problem.
A massive one. The U.S. Treasury is actually freezing the size of its bond auctions for right now, from February through April, which sounds responsible. But when you look at recent analysis for 2027 and 2028, there is a projected funding gap of $1.1 trillion.
$1 trillion that we just do not have.
Correct. And to get that cash, the government has to sell bonds. Now think about basic supply and demand. If you flood the global market with U.S. bonds, the price of those bonds drops. And in the bond world, when prices drop, yields, which is the interest rate the government has to pay out, go up.
So the government basically has to bribe investors with higher and higher interest rates just to get them to buy all this new debt.
Exactly. But historically, the U.S. government was the only giant whale in the ocean. If Uncle Sam needed money, everyone lined up to lend it to him. But this time is very different. There's a new whale in the water.
The AI arms race.
The hyperscalers. Companies like Amazon, Microsoft, Google, Meta, they are building out AI data centers, at a speed we have never seen in economic history. And these things are unbelievably expensive. You need specialized chips, advanced cooling systems, massive plots of land, and literal power plants to run them.
And they are not just paying for all this with cash they have sitting in the bank.
No, they're borrowing heavily. Looking at the data for 2025, just the top 5 tech firms issued $121 billion in corporate bonds. And analysts expect them to issue about $140 billion every single year moving forward.
So paint the picture for us. Imagine I am a manager for a huge pension fund. I have $1 billion that I need to lend out for the next 20 years to get a safe return for my retirees.
10 years ago, you would just buy long-term U.S. Treasuries. Safe, boring, guaranteed. But today, Microsoft knocks on your door and says, hey, let us borrow that billion. We have incredible cash flow, we have this massive AI growth engine, and we will offer you a highly competitive interest rate.
So it is a brawl.
It is a total brawl. We call it a crowding out effect. The U.S. government and big tech are effectively fighting each other for the exact same pool of lenders. And when two massive borrowers compete for the same cash, it forces the risk premium up.
Okay, term premium or risk premium, define that simply for the learner.
It is the extra fee you demand for locking your money away for a long time. It is a premium for dealing with the unknown. If inflation might spike because of new tariffs, or if bond supply is going to explode because of government deficits, you demand a higher interest rate to take on that risk.
Which means even if the Federal Reserve is cutting short-term interest rates to try and help the economy, your 30-year mortgage rate could still go up because of this brawl in the bond market.
That is the nightmare scenario. Short-term rates drop, but long-term rates climb because the market is just choking on too much supply.
And speaking of the Federal Reserve, we have a wild card entering the game. Current number 3 for our duck.
Yes, President Trump has nominated Kevin Warsh to be the next Fed chair.
And Warsh has a very specific reputation on Wall Street, doesn't he?
He does. He is a fierce critic of something called forward guidance.
Which is basically the central bank telling the market exactly what it's going to do before it actually does it.
Right. For the last 10 or 15 years, the Fed has treated the market like a toddler at a playground. They say, okay, in 5 minutes we are leaving the park. Now we're leaving in 2 minutes. Okay, time to go. No surprises.
They hold the market's hand.
Exactly.
Yeah.
But Kevin Warsh, he is more of a get in the car, we are leaving right now kind of guy.
Yeah.
He strongly believes the Fed should not give out spoiler alerts. He thinks they should react to the economic data in real time, not make promises about where interest rates will be 6 months from now.
So if he gets confirmed, the hand-holding stops.
The safety net vanishes. If the bond market is used to being babied and suddenly the Fed goes completely silent on their future plans, volatility could absolutely explode. Suddenly, every single inflation report and every jobs number becomes a massive shock event.
Wow. Let's synthesize all of this for the listeners. When we step back, we are seeing a political landscape shifting from incredibly fast executive action under the old trade laws to much slower, stickier regulations under Plan B.
And at the exact same time, we have a financial landscape shifting from an era of easy money to a crowded capital war between Uncle Sam and the AI tech giants.
The timelines are what really jump out to me. You pointed this out in the prep for this deep dive. Look at the calendar for the second half of 2026.
It is a convergence. First, you have July 24th, 2026.
Yeah.
That is the exact day the temporary Section 122 tariffs expire.
The policy cliff.
Right. Will the administration renew them? Will the slow Section 301 investigations actually be ready in time? Nobody knows.
And right as that political uncertainty hits its peak,
The U.S. Treasury has to start massively ramping up its borrowing to cover that trillion-dollar gap we talked about. And remember, if they start losing those court cases about the illegal tariffs, they might need to borrow another $175 billion just to pay out refunds.
it feels like a collision course. You have sticky inflation coming from this messy tariff transition, crashing head-on into super expensive debt in a crowded bond market.
And if Kevin Warsh is running the Fed by the fall, he might just sit back and watch it happen instead of coming out with a speech to calm everybody down.
So for you listening out there, the learner what is the practical takeaway? We obviously don't give direct financial advice on this show, but how should someone be viewing the world right now based on this data?
My biggest piece of advice is do not get lulled to sleep by the quiet stock market. The S&P 500 might keep drifting upward for a while. It's going to look like that calm duck.
But you have to watch the plumbing.
You have to watch the boring stuff. If you were scrolling the news and you see a headline that says U.S. Treasury auction sees weak demand stop, and read it, That matters way more to your actual financial future and your borrowing costs right now than what some retail store reported for their quarterly earnings.
And definitely keep an eye on July.
July is the ultimate pivot point. If the transition from this temporary bridge to the permanent tariff roads gets messy, the costs of everyday goods are going to jump. And if the bond market throws a tantrum at the same time because there's too much debt, we could see a very sharp correction.
You know, it is really interesting. We have spent the last few years totally obsessed with speed. Fast tech, fast news cycles, fast executive orders. But based on everything we discussed today, it really feels like we are entering an era of the slow grind.
Yeah, bureaucracy is inherently slow. Paying off national debt is slow. Pouring concrete for data centers is slow.
But the way the market prices in all that risk, that can happen in a flash.
Absolutely, in the blink of an eye.
Well, I want to leave you, the listener, with a final thought to chew on this weekend. If the Supreme Court just permanently took away the president's fastest economic weapon, and the bond market is getting so crowded by AI spending that borrowing is becoming a struggle, are we entering a new era where politics is forced to move slower, but our financial markets become violently more volatile? Something to think about.
It is the defining question for the rest of the year.
Well, we will definitely be watching that February 24th start date for the new tariffs very closely. Thank you for helping us map out all these side streets today.
Anytime. Thanks for having me.
And to our listeners, thank you so much for tuning in. Don't forget to subscribe and hit that like button.